Welcome to Socially Responsible Investing Podcast, brought to you by AIO Financial at AIOfinancial.com. This is episode 12. I'm Bill Holliday, and in this episode, I'll be speaking with Adam Strauss of Appleseed. Appleseed is a standout amongst SRI, Socially Responsible Investing mutual funds. Morningstar categorizes them as a U.S. mid-cap blend fund, but they have about 40% in foreign holdings, 42% in large companies, 27% about in cash and gold, and their holdings are concentrated in 20 to 25 stocks. I started by asking Adam about his background in the history of Appleseed.
The advisor to Appleseed Fund, that's the company that manages all the investments for the fund, is a Chicago-based investment advisor called Pekin Singer Strauss Asset Management. And that's the firm I work for. And we've been managing money since 1990. And today we manage around $900 million, including the mutual fund, Appleseed Fund, that we manage. And so since our beginning in 1990, we've been picking stocks through a value investment strategy. And so, what that means is we look to find companies that have some temporary problem that we think is going to pass, but that temporary problem causes the stock price to go down and for investors to not want to own it, and that allows us to buy in at a low price. And there's a lot of research that shows that over the long run, value investing tends to outperform the market. And so I mention this because, somewhat ironically, a lot of socially responsible mutual funds tend to be a little bit more growth-oriented. So I think there's an important niche that Appleseed Fund fills in the SRI space, being that we're value investors. But
definitely, there is a lack of value funds available.
Yeah, I think so too. And so, anyways, just getting back to the history. So, in the early 2000s, we felt like we had a really good investment process that we developed with and a really good track record, but nobody really knew about us. And so we decided at that time, it was around 2005, to launch a mutual fund. So, we did some research, and in 2006 we launched the Appleseed Fund. And today Appleseed Fund is about 6 years old. And our stated goal is to generate market-beating returns over the long term by making prudent, disciplined, and sustainable investments. And since we launched that fund in 2006, we've been meeting that goal. Our returns have exceeded the S&P's return by about 4.5% per year. And we've been doing it by taking a lot less risk than the market as well. So, for example, in 2008, which was a period of a huge market decline, I think the S&P 500 declined by 37% that year. We were the number one performing mutual fund in our category because our decline was about half of what the market declined. So, our goal is to pick sustainable investments and to pick undervalued investments, and we expect that over time, by doing that we're going to be able to beat our benchmark, which is the S&P 500 index.
Great. And where do you categorize yourself? I know Morningstar has you as a mid-cap value, but I see in the holdings there's about, right now it looks like there's around 23 stocks, but 40% foreign, some very large and some micro.
Yeah, so Morningstar doesn't really have a good category for us. If I were to categorize us, I would categorize us as an ESG fund that is really a go-anywhere value fund. And what that means is that wherever we see an undervalued stock, assuming it meets our environmental, social, and governance criteria, we can buy it. And so we have small cap stocks in our portfolio, medium-sized stocks in our portfolio, large cap stocks in our portfolio, and then we have both domestic and foreign stocks in our portfolio. And so, and Morningstar doesn't really have a category for go anywhere value. So, where they have us right now is mid cap value. It doesn't mean that we have all mid-caps. It's just sort of that's the center of all the different stocks that we own.
Sure. And about how long do you typically hold a company, or does it vary all over?
It really varies. I mean, when we take an initial position in a company, it's because we can buy that stock at a price that, for us, we think there's going to be minimal downside risk and at least a 50% upside between where the stock is currently traded and our own independent estimate of intrinsic value. And so if we buy a stock and, it goes up 50% the next week, we'll sell it. But if it takes, if it takes 5 years to get there, then we'll own it for 5 years. Hopefully along the way, the company is doing good things, and so the value is increasing even while we're waiting for that 50% upside to occur. So hopefully by the time, if we wait 5 years, hopefully it'll be more than 50%.
Sure.
But, so we don't really have a predetermined time, but we're happy to be patient. If we like a company and we think they've got good management and a good story, and we think that they've got good environmental, social, and governance characteristics, and we think it's an inexpensive stock, we're happy to hold it over the long run. So we have owned stocks for just months, but we also have stocks that we've owned since the very beginning of the fund.
That makes sense, that you're constantly evaluating how they're doing versus your estimate of their value.
Right.
And make your decisions based on that. So speaking of that ESG screening process, what are your screening criteria? I guess what are your ESG screening criteria?
Sure. Before I get to the ESG criteria, I just want to mention, I mentioned earlier our valuation criteria. Another non-ESG criteria is we actually have a team of portfolio managers at Appleseed. So there's 5 of us. And in order for a stock to go into the portfolio, 4 out of 5 of us have to approve it. And so there's sort of 3 things that have to happen to go into our portfolio. It has to have a 50% upside with minimal downside risk. It has to be approved by 4 out of 5 of our portfolio managers, and it has to meet our environmental, social, and governance criteria. And so,
to jump in on there, you have a small number of holdings. Is that also on purpose, that you're going to keep a low number of holdings?
Yeah, it's a pretty concentrated fund, and this might be a consistent theme that you're hearing, but we're very risk averse. And so, and even our environmental, social, and governance criteria is really, in our view, a mechanism for reducing investment risk. But we also concentrate our portfolio because of investment risk issues. I mean, we think that it's lower risk to know a few companies really well and to be very comfortable with the price that we're paying for those stocks than it is to own 100 holdings and to only know each of those 100 stocks a little bit and to get somewhat near a market return. I mean, we think that over the long run, we're going to serve our investors better by owning only our best ideas, but to concentrate those best ideas.
Sure. Yeah, that makes sense.
So, okay, so you want me to go back to our ESG screening criteria?
Yeah, if you would.
Okay, so our screening criteria, we have both negative and positive ESG screens in the portfolio. So, on the negative side, there are certain industries that we'll avoid. We avoid gambling, we avoid weapons, we avoid alcohol, tobacco. We look at environmental measures such as greenhouse gas emissions per dollar of revenue or toxic spills per dollar of revenue. And then, another sort of important negative screening criteria that we use is that we screen out all of the too big to fail banks. And as far as I know, we're the only SRI mutual fund that has a screen against the too big to fail banks.
I'm not aware of another one, but I like that screen.
Yeah, and I hope other funds will add that screen because I think it's important. But it's something that we added in 2010 when the world evolves and the economy evolves, and in my view, ESG screening criteria has to evolve along with it, and so that's why we made that change. But then on the positive side, we look for companies that operate businesses whose core product or service might make a positive impact on the environment, or with regards to human rights issues, or with regards to community investing. So just, one example I'll throw out is a company called John B. Sanfilippo and Company. It's a small cap stock. It's actually one of the stocks we've owned since the fund was formed. They are in the business of producing culinary nuts, so peanuts and cashews and almonds and products like that. And so we like this company due to the products they make. Nuts are a high-quality source of vegetarian protein, and researchers have found that people who eat nuts regularly have low risks of heart disease. But we also like nuts because of the environmental impact of eating a vegetarian source of protein. Producing Johns Hopkins, I think, did research that shows that 1 pound of feedlot beef requires something like 2,500 gallons of water and 7 pounds of grain. And if you consider how much beef is in the average American diet, our thinking is that by investing in a company that's promoting a vegetarian source of protein, it's there's a real big environmental impact to even modest reductions in meat consumption. So it's just sort of one example of how we try to apply positive screening criteria to companies in our portfolio.
That's great. And with your, screenings, do you talk to companies and say, we like you for a lot of reasons, but there's a couple issues that we need changing before you're considered for our portfolio?
I guess what I would. I think that there's sort of two different levels. So there's some companies where they're fairly far away from where we need them to be in order to buy them in the portfolio, and in that case, we're just going to pass and move on to something else. But if there's a company, but there's other companies who, no company is perfect. So there's companies that might meet our screening criteria, but there's lots of things that they could do that they're not necessarily doing today. And that's when we get involved more on the shareholder advocacy side. And so, we will do things like talk to management about issues that are important to us and concerns that we might have, so that we can influence them to manage their company in a more responsible manner. We do it through our proxy voting, and we do it on occasion where needed through the initiation of shareholder resolutions as well.
Okay. So you're picking mostly based on these criteria, and then of the ones you have, you'll try to influence as you can, or as you see a need arise.
That's right.
Okay. And then your screening, is that a pretty standard SRI screening? I know that too big to fail is different, but the other seems pretty standard.
I would say for the most part, that's right. I would say that the one big difference is the too big to fail banks, but besides that, I think it's not too different than what you'll see at other SRI mutual funds.
Okay. The pollution is kind of a judgment call. What's too much versus an industry standard. The others are simply avoiding, avoiding different areas or positively, looking for those.
Right.
So, and how do you feel the SRI strategy, these SRI funds, including your own, can make a difference or influence companies? Do you see companies working to attract investor dollars by, trying to comply with these screens?
Oh, I think so. If you look at what, especially among large companies that have more resources, I think, to implement sustainability programs, there's just a lot more sustainability reporting than you used to see. A lot more sustainability sections on companies' websites where they're trying to communicate to investors all the things that they're doing to make their company more sustainable, and also more real action in the area of sustainability. Now there's some greenwashing too, and so the prudent investor has to sort of distinguish between what's real and what's not. But
And what's a marketing ploy?
Right, but
yeah.
but I do think that there's a larger awareness of sustainability today, and more of a real effort by companies, and I think a lot of it has to do with pressure from investors.
Yeah. No, that makes a lot of sense, and it seems like it's changed dramatically in the last 6 years, or longer as well. But recently, it seems like there's been a lot of changes.
I think so, and I think that I would also say that it goes beyond just investor pressure too. I mean, the world has changed so much in the last 10 years or so. I mean, I think that there's a wider acknowledgement today that we're running down the natural resources of the planet, and we have to be more efficient about the way that we consume those resources. And companies are recognizing that, and it's just look at where energy prices are today versus back in 2000. I mean, it's not just attracting investors; it's also good business sense. If you can figure out a way to reduce pollution or be more energy efficient, it's going to help your business as well. So I think that there are some real business reasons for companies to pursue sustainability above and beyond just attracting SRI mutual funds.
Sure. A couple other questions about your portfolio. One is with foreign investments, do you limit the scope or where you're investing, whether it's emerging or developed, or is it anywhere?
We don't have a purposeful limit, but I think that most of our investments are in in the industrialized world. Most of them are in Europe and in Japan. I think there's one investment that we have in a developing country. We own SK Telecom, which is located in South Korea, and I mean, you might even make an argument that that's not a developing country.
Right.
I mentioned at the beginning of this interview and several times that we're fairly risk averse, and in our view, a lot of the developing country stocks are much higher risk, and so I think we feel more comfortable probably investing in companies that are located in Europe and Japan.
Sure. Yeah, and the disclosure is pretty.
There's more confidence
similar.
behind the accounting, behind the the regulations, behind the various markets in those countries. There's a whole slew of reasons that make developing country investing higher risk. Which is, I'm not going to say that we won't do it, but we've done it in very limited amounts, and for the most part, it's related to our risk aversion.
Yeah. The portfolio generally has about a quarter of it in cash and gold?
That's about right.
That's
basically the capital that we have on the sidelines waiting for new opportunities to invest in undervalued sustainable stocks.
So that could go down. It's not that.
Yes. Yeah.
Okay.
So, for example, in the spring of 2009, when the markets were just crazy and everything was so inexpensive, we had our cash and gold position was almost zero because there was value everywhere. Sure. We're seeing less value today, and so we have a little bit more capital on the sidelines just to make sure that we have dry powder so that we can invest in case there's some kind of a correction.
Gotcha. No, that sounds like you have a lot of flexibility with the fund. Make some judgment calls. And it looks like even your turnover ratio varies quite a bit year to year, just depending on what the conditions are.
Yeah, that's right.
Yeah, that makes sense. And I guess any thoughts for the future for Appleseed? Do you see other funds coming out, or? There's no immediate plans for a new product. Our goal right now is to just continue making sure that our core fund, the Appleseed Fund, is the very best investment vehicle we can make for our long-term investors. So, we don't have any immediate plans. We're just really focused on investing for Appleseed Fund.
I guess anything else you want to add about the fund or your firm or SRI in general?
I really appreciate the things that you're doing to increase exposure for SRI funds and for socially responsible investing in general. I mean, I'm a huge, I'm very optimistic that as time goes on, that we're going to see more and more investors move in that direction, because I just think it's a better way of getting strong risk-adjusted returns. We've employed that with great success at Appleseed Fund, and I think our results speak for themselves. And so, I appreciate you taking the time to interview us, and look forward to keeping in touch.
Thanks. Yeah, and I guess that is a good point, that it's not only screening for a better planet, it's also you can improve returns or minimize risk looking at some of these screens.
I think so. I mean, I think that I think that there are reasons to do it from a value standpoint, but I also think there are reasons to do it from a performance standpoint, and it's wonderful that you can get both.
Yeah. Do you have any thoughts of why there are so few on the value side? Is it mostly just because they're avoiding energy or avoiding some of these areas that there's very few SRI offerings on the value side.
I was hoping that maybe you could explain that to me. We launched our Appleseed Fund as a value product because that's what we do. I mean, that's just sort of who we are. But I was very surprised to see, having launched that fund, that if you sort of map all the funds on that 3x3 Morningstar box, that most funds are in the sort of tilting on the growth side of the spectrum, and there's really hardly anything besides Appleseed Fund that's on the value side. So I think if you're a socially responsible investor and you want a diversified portfolio, I think you have to look at our fund, because it's an important diversifier. You don't want to be just in growth, especially when there's a lot of research that shows that over the long run, value investing is a superior way of investing.
I agree. The diversification helps, because they're not all going to cycle together either.
Right.
Great. All right. Well, thank you very much for your time, Adam.
Oh, well, thank you for your interest. I appreciate it.
To summarize, Appleseed, ticker APPLX, mutual fund, is an all-cap value fund, and they have a lot of flexibility in their investments. They can vary the amount they keep in cash or out of the market. They have some in foreign. A lot of that can vary, but they tend to be on the value side and averaging a mid-cap holding. They use basic ESG, environmental, social, governance screenings to avoid companies that produce weapons, are involved with gambling, have high pollution for the size of the company, high greenhouse emissions. In addition, they have a too big to fail bank screening. They also use positive screens for products that are produced, and they are involved with proxy voting and shareholder advocacy. This is not the first time we've heard that ESG screening does help stability and performance of a fund. So it's not only good to look at these ESG screens for social impact, but performance. This podcast is intended for informational use only. We are not making investment recommendations. This is not an appropriate investment for everyone. Appropriateness depends on an individual's financial objectives, their risk tolerance, their liquidity requirements, their tax situation, amongst other factors. As with any investment, please read the prospectus and discuss it with your financial planner. And that's it for episode 12. Next podcast, we will be speaking with someone from RSF Social Finance. Thank you for listening to the Socially Responsible Investing Podcast. I'm Bill Holliday with AIOfinancial.com. Please feel free to contact us. I welcome suggestions, comments, questions. You can email me, bill@AIOfinancial.com, or call 520-325-0769. Thank you.